Friends, finally, investing in fixed deposit is turning out to be advantageous after 31st of March 2023 in comparison with debt mutual funds. So for those of you who are not aware what is debt mutual fund, we are going to see what is debt mutual fund all about, and whether after the finance bill amendments have been cleared, and one of the amendment in the bill is to actually keep on par the taxation rules for both debt mutual fund as well as fixed deposits. After this amendment has been passed, it is still advantageous today to invest into fixed deposit or today to invest into debt mutual funds, or after 31st of March 2023 it is advantageous to invest in debt mutual funds or fixed deposit. We are going to see all these aspects in this specific video. So please share, subscribe, please share it to your friends and relatives so that they can get an understanding what is debt mutual fund first of all, and whether it still holds an advantage to invest into debt mutual fund after the finance bill amendment have been cleared today, and I am making this video today. So first thing, what is debt mutual fund all about? So debt mutual fund, my friend, is a financial instrument wherein the fund manager invests in three types of financial avenues. The first avenue is bond, the second avenue is commercial paper, and the third avenue is certificate of deposits. So we are going to understand a little bit about each of these three avenues, what these actually three avenues represent in terms of investing. So when we come to bonds, bonds typically invest into securities. That means the corporate and the government bodies issue these bonds on the platform, which the fund manager of the particular mutual fund invests the capital of the pooled investors into this specific bonds in terms of like giving, it's like a loan which is provided by the public, although by the institutional investors, to the corporate bodies as well as the government bodies, so that they can raise capital for themselves, and in exchange of this capital they give you an interest rate, specific interest rate. So you get a coupon rate or interest which is calculated on the percentage of your capital invested, and depending on the coupon rate, that is 7% or 8% or 9%, whatever the percentage could be, you will get an interest amount coming to a bank account either on a monthly basis or a quarterly basis or on a twice in a year basis or after the end of the year. It depends on the type of the bond. There are so many types of bond, almost 5 or 6 categories of bond itself. So now the second avenue of investment, that is the commercial paper. This commercial paper is issued by corporates. So when this corporate issues commercial paper, of course they are going to give you some kind of a coupon rate or some kind of a interest upon your particular investment. So these commercial papers are short term in nature to fulfill that corporate short term obligations. It could be like trade payables for which the corporate needs to immediately pay to the supplier, wherein they need cash at present because they are not having immediate cash available, or they might have to break a long-term investment. So to avoid breaking the long-term investment, they issue commercial papers to public, and public invest the capital and they get a share of percentage of interest from the corporate bodies. So that is about commercial papers. And the third instrument, the third avenue of where the debt mutual fund actually invests into is certificate of deposits, which are issued by the bank. These are almost similar to fixed deposits. This certificate of deposits are actually insured by the FDIC, Federal Development Insurance Corporation of India, and is backed by, it has a RBI backing, so it's very much secure in comparison with commercial paper, which is unsecured. So when we compare debt mutual fund with respect to equity, equity is very volatile, lot of fluctuations in the market. But in comparison with debt mutual funds are less volatile, very less volatile for the matter of fact, and they are very stable in terms of returns. So the type of returns the debt mutual fund provide an investor is almost similar to that of the fixed deposit. Now brings us to a second topic of discussion, whether after the amendment, does it really make sense to invest into debt mutual fund, or does it make sense to invest into fixed deposit? So before 31st of March 2023, if you still invest into debt mutual funds, it is going to be advantageous with respect to fixed deposit. But after 31st of March 2023, if you continue to invest into, that means new fresh investment, if you continue to make into debt mutual funds, Now it depends. There, it could vary for various investors whether it's going to be turning out to be an advantage when you try to invest into debt mutual fund at that point of time after 31st of March, or whether it turns out to be an advantage to invest into fixed deposits. But nevertheless, from a very generic perspective, after 31st of March, fixed deposits turns out to be much more advantageous, but that doesn't mean that debt mutual funds are disadvantages. They are almost same, so you could choose. So let's see, before 31st of March, what were the advantages of debt mutual funds? When it talks about debt mutual fund, the primary advantage and the secondary advantage, both advantages I'm going to discuss with you. The primary advantage is that debt mutual fund have an index cost applied to it upon your withdrawal. And the taxation, that is the second advantage, the taxation does not apply to debt interest which is being paid every year on year to you, not into your bank deposit directly, but you can see its appreciation on either CAMS or CAVI portal. You can see its appreciation on the AMC site as well. These interest accumulation are not being taxed until it is withdrawn. So first is the delayed taxation, that is one of the advantage. It is delayed till you withdraw. And the second advantage is if you withdraw, it will be applied an indexation cost. That the indexation cost increases almost by 4 to 5% as per the rules set by the RBI. So your purchase cost is going to increase, so that is thereby your tax outgo, whichever you are going to pay on the interest accumulated over a period of time on debt mutual fund, is going to be significantly lower compared to fixed deposits. When you compare to fixed deposits, when you put your capital in fixed deposits, whatever interest is earned in the specific year, you are taxed immediately at the end of the year. Whether it's to your interest to withdraw it or not, it doesn't matter. The moment the interest is paid by the banks on your fixed deposit, by the end of the year, you are charged tax. In contrast, on the flip side, when it comes to debt mutual fund, the taxation is delayed unless you withdraw. And if you withdraw, you get an additional benefit of 4 to 5%. Your purchase cost actually increases. Now, how does it actually benefit? You're going to see an example which I'm going to flash it out on the screen. And this example is taken from the Economic Times. I found it very easy to understand. So this example applies to those who are working and who fall on the maximum tax bracket of 30%. So depending on the tax bracket, the advantage holds. So when it comes to say, when I explain fixed deposits, the interest or the taxation on the interest is applied immediately. But for those who fall below the tax slab, even though they may be getting an interest, for those who fall below the 7 lakhs tax slab, they have a nil tax outgo to pay. But when it comes, those same people, if they invest into debt mutual funds, they have to compulsorily give a tax outgo of almost 20%, irrespective of the tax slab. So to that extent, if you're a retired person and if you are having my income from fixed deposit up to 7 lakhs, then no need to worry, no need to bulge out into debt mutual funds. And if you're having a tax outgo much greater, if you're a working professional, I think it makes sense to invest into debt mutual funds to reduce your tax outgo, as you see on the screen. And I'm going to read out as it says on the screen. So the investment here, it is shared by Edelweiss actually. Let me be clear. And the invested amount in the debt mutual fund, it says it's about 5 lakhs. And in bank fixed deposits or post office deposits are almost also about 5 lakhs. And the number of years invested is 5 for both. The assumed rate of interest is about 7%. The value after 5 years on both these almost are same, that is almost about in the range of 7 lakhs. And the index cost on debt fund is applied before 31st of March. The indexation will be applied. So your taxable amount on debt mutual fund reduces to almost about 92,950 with comparison with bank fixed deposits almost about 2 lakhs. So the tax applied on debt is almost about 19,000 or so, and on bank fixed deposits 62,000. This is assuming you are on the highest tax bracket of 30%. If you are in the low tax bracket, you don't have to pay any tax outgo, which is within 7 lakhs, but still it is advantage. In that case, it is advantageous to put your money into fixed deposit. Now, after 31st of March 2023, for those who fall in the maximum tax bracket of 30%, your indexation benefit will automatically go. So it will become almost same as that of the fixed deposit. So that means your tax calculation on fixed deposit and debt mutual fund is going to be the same. But provided you do not, provided you withdraw it. If you do not withdraw, there is no tax calculation at all, even on debt mutual fund. The tax calculation only applies on the fixed deposits. So after 31st of March, both of these are same. So I think you can choose either fixed deposit or debt mutual fund. So the advantage, the percentage return you're going to get is the same on either of this. But before 31st of March, if you have capital, you can invest into debt mutual fund if you are falling in a higher tax bracket. If you're working professional and you have fallen in a high tax bracket, but if your income is up to 7 lakhs from this fixed deposit, need not diverge there into debt mutual fund in a hurry. That is what I have to say. Okay, so before 31st of March, for those who are working professional and falling in a higher tax bracket, even more than 10% bracket, it is advantageous to invest into debt mutual funds. You get a advantage of indexation benefit plus the withdrawal benefit. Upon withdrawal, only you have to pay the tax. And if you are in a retired category, earning fixed deposit interest up to 7 lakhs, then no need to worry. You just continue keeping your money into fixed deposit, continue to invest into fixed deposit. Your interest payment, though you're paid at the end of the year, it is not being taxed nevertheless. So it's an advantage for a retired person who is not falling in any tax bracket or falling into a 0% tax bracket. Investing in fixed deposit is advantageous compared to debt mutual fund. But after 31st of March, for those who are working or retired, either of it is your choice. But for those who are retired and earning up to 7 lakhs, fixed deposit, blindly go ahead with it. So that is all I wanted to share in this specific video. If you are looking for certain answers to certain questions, you can drop in a question in the comment section, and I will be glad, to answer to your comments within at least 24 hours or so. In case I'm not aware of it, then I'll do my research and get back to you nevertheless. And you can write to me on my Gmail ID in case you're interested into a mentorship session to understand how to invest into either equity market and how equity investing can be advantageous even in comparison with fixed deposits or even in comparison with debt mutual funds. So my friends, I hope you have liked this video. Please like it, share, subscribe, and looking for you in my next subsequent videos, which is shared on almost every alternate day. See you until then. Happy investing.